Good day, traders. Stacey Burke from Stacey Burke Trading. Today, talking about filtering out the best setups, identifying which pairs may be giving the best trade opportunities, not only on the day, but maybe for a session. My basic setup, normally, if you've been following me now, you know that I'm normally looking at NASDAQ, gold, and oil. That said, I will scan through all the major pairs, and the first thing I'm looking for each and every day is which pairs are potentially near a previous day's high or low. When the session ends, I want to know, how did the day close? Was it a strong moving day into the close? I look for a rollover trade. We haven't talked much about that, but I'll talk more about that in the next few videos. But I'm looking for which pairs are near the low or high of the previous day. Now, again, with any of these pairs, I'm looking at where are we at within the week, so my weekly separator. Then I know where my weekly daily high-low peak formation may occur in terms of a Friday, Monday, Tuesday, that sort of pattern. And we can see clearly there's been a 3-day setup on the NASDAQ headed into last night's U.S. session. So this allows me to filter out potentially maybe the weaker of the three. And yesterday, I know a lot of traders asked about gold, and one of the things that sort of disinterested me right from the start of the day was that gold was inside of Friday, Monday, Tuesday. So Tuesday, Monday put in a peak formation low through Friday's low. Tuesday took out Friday's high and also had volume trapped below the Asian range. And so when the day started, as you can see, we were inside, and that's sort of my criteria where we get into a lower probability situation. I'll just recolor this box if I can get into that. And when it's inside like that, I'm not as interested in trading because, as you can see, we end up having to go through an auction process typically, unless it's going to be a day that moves strongly through down towards one previous day's breakout level or above, because then we have maybe a market that's on a run for a move down to the low of the week or up to the high of the week. And so when we get a day like this and we're inside, I want to see two clearly defined boundaries that reestablish the highs and the lows. And if that doesn't occur at the timing window, last night's short trade occurred just in the gap an hour outside of the U.S. window. But again, looking at my best candidates, I liked the NASDAQ and I liked oil. Now, oil gave two specific trades. And again, if we just back this up and look at the week, we had a peak formation low on Monday that took out the high of not only the previous week, but the previous day, obviously. And then we had a cluster of volume that collected. And that market closed in the U.S. session down at the low, 300 pips down. And as we talked about yesterday, that market then proceeded into the close to come up 300 pips, which gave a nice sell setup right at the beginning of Asia down into towards that higher low. And then again, we had three levels of rise, which was a 100 pip box right at the beginning of the Europe session for a vertical move right at the open of Europe. And that took us straight back to the low. But when we step back, again, I'm just looking at the highs and the lows. And to clarify, just so you understand, and somebody pointed that out this morning, I'm not interested in trading on the inside. So traders sometimes will be in an all-day fade or a move from one side to the other. And again, that's, whatever works for you. It's whatever you identify as your niche. But I'm looking for these setups at the timing window. And so we got three levels of rise right at the U.S. session last night. There was a small reversal right in the first 15 minutes that occurred. So the second point I want to talk about is that when you have your high and low established, talk to Mr. Freeze. You asked about the indexes. So one of the things that I do is after London and Asia has traded, I look at my levels on an index. So if we take for example, the NASDAQ, I'll put my 12 candle window box on here, and this will make it a bit clear. NASDAQ. when I have London and Asia already traded, we're either going to be near the outside or the inside. Now, the previous day on Tuesday, we have a market prior to the U.S. window. I will draw my highs and lows. If we have a breakout from a session, I will draw the breakout level. And so we had a peak formation in the gap and then 3 pushes, 1 push down, 2 push down heading into the U.S. session. What I want to know is where's 25 to 50 pips outside of the range. And what that does is it gives me my levels that when 9:30 New York comes on board, I know where my strike zone is. So we had 2 pushes down. New York market opens inside below double zeros. I'm talking about 9:30 specifically. And if we go to a smaller time frame now, when I look at my levels for my strike zone, that's 25 and 50 pips above where the current session high is and the most recent swing high. So the first quarter level clears out all the stops. If they proceed further in that first 15 minutes, then I'm just all I'm doing is watching the time and the price action. If they go up here, so 9:30 is this first pin that oscillates both sides. I'll just draw a box around that. Okay, I want it to go to the outside. I want it to go to the outside because that means we've hit stops, and then I'm looking for the reversal pin hammer. We get it up top. Okay, you shouldn't. I don't do anything until I get this. But again, look at the time. We're now at the end of the first 15-minute bar. So my first area for a strike zone trade is after they've cleared stops and we get a pin hammer at numbers at that level. It's a 1-bar stop. Now I can get in here and depending on the setup, the template, we're at the high of the week at this point on day 2. This is where I would take my first position. I'll put a 20 pip stop in there. The first thing it should do is react in the direction of my trend. If I'm wrong, I'm going to get stopped out. That's my initial feeler trade position. If it confirms, and I'm going to hold on to this, I will look for them to pull it back and add a second position. The first thing it should do is clear out the higher lows from where the market started. 9:30. Okay, New York opens, they hit the stops on one side, they come back to where the move originated, and then if we're going to go to the other side of the range, so again, my target, you got to remember, we're going for the money. Who's in the money? If they go to the top of the day first, we got a peak formation already in place, potentially at the first quarter level, which clears out all the lower highs. So remember, we opened up inside, they went down first, they made a low. Now, coming back to understanding where that low originates at in the U.S. session, 50, 1 push, 2 push, 3 push. They're at 50. 3 levels of rise from 50 is our first quarter level. That's why it's 25 pips above the lower highs. It's my first area for a strike zone. We're inside of a peak formation, and I'm looking for that in the first 15 minutes. Why? Because that's when they'll hit the stops. That's typically going to be 3 pushes. If it's a breakout, it will explode through the whole thing in the first 15 minutes. That is a stop hunt pattern. Now we'll go back. So again, first position, or I could be in and out, or first position, adding into it, holding with the thesis being it's going to go all the way down in 3 bursts or 3 pushes. So if traders were early and they traded in this first part of the 12 candle window, obviously there's a trade on the third level. They can add to it. We have a 1, 2, 3. Okay, if people ask me what's a 1, 2, 3, count the bars at the high. 1, 2, 3, engulfment. That's as simple as that. This can be on a 15-minute, an hourly, a 1 minute. But again, the 1 minute is tied in with the thesis of the whole day. Now, when New York opens, okay, the first thing they do, we have our lower high. So again, I've already dropped down. New York hasn't opened yet. When New York opens, they pin up and take the market down lower and engulf. We then get a vertical move. This is in the first 15 minutes. Again, timing is everything. They go vertical and they hit the stops and they come back to 50 and give us a pin hammer. We're in a broken down market. This is after we've hit stops. When you follow this market and do this enough times, you'll start to see the same behaviors over and over again. That's a 75 pip plus move straight down that's over in 4 minutes. This is why I encourage traders. Okay, our direction is down. They've stop hunted up and hit the lower high. This is the last lower high before New York opens. Therefore, that's my high of the session. Obviously, the high of the day is up here. But that's where the market pins and then takes the market 3 levels down, engulfs, comes back and hits the stops. They're getting traders short at the beginning of the session. And then bang, they hit the stops. They hit them a second time. There's our pin hammer at 50 into a peak formation. So again, spot the peak formations. It's a 1-bar stop. My thesis is that this market should go down super fast, which it did. I'm out at the low. I don't hold on for more. In a vertical market, that's a stop hunt. They came back a second time. There was opportunities for traders to go long. Again, my objective when I'm at the screen is to take a trade and be done. Sometimes there'll be a first leg and a second leg or a trailer position, but usually in a vertical move like this, I will be done and out of the market. But just hammering home for the NASDAQ, 25 to 50 pips outside of the high or the low. On Tuesday, we had 3 sessions of rise. This is my favorite pattern. We saw this on oil yesterday. Over the course of the day, we see it on gold all the time. Asia came all the way down, but over the course of the day, they proceeded to put in level 1, level 2, and then into the U.S. Open, 25, 50, and 75 pips from where the move originated. So, again, counting 3 levels of rise. That 3 levels of rise is before New York opens, before the NASDAQ market opens. Again, I'm skimming through this to paint the scenario. So when London puts a low in place, okay, the same thing. I draw a box, and I draw a box on the top. Now, they went up there in the first hour of the U.S. session through the highs of London. Remember what that does. This is before the NASDAQ opens. Before the NASDAQ opens. That gets traders triggered long at the high of the London session. It gets traders long at the beginning of the U.S. window. Then the market comes down 3 levels. So somebody asked me, but I count 4 levels. The first level is level 1. That's consolidation. Then we're into level 2. Level 2 can be 25 to 50 pips. And level 3 is the blow-off move. You'll notice where my strike zone levels are. 25 to 50 pips below the low of the day. What do we get down here? A pin hammer and an engulfment. So traders don't want to hit this sometimes. They're like, well, yeah, but you're buying into a falling knife. No, I'm not. Because remember what my thesis is. The market's going up, and I'm buying at the low of the London session. This is a box. I want to buy low, and I'm selling high. I'm looking for them to hit the stops. Hit the stops. If you want to get it on the right side of the W, you can do that. I'm always expecting a retest into that peak formation low. So whenever they go vertical, think peak formation. Peak formation low. What do we know about peak formations? Don't countertrend the peak formation. Level 1, so the consolidation, the peak formation, the triple bottoms, triple tops, those are all level 1. When the market comes out of level 1, we're now into a level 2 trade. That market may do a level 2 and then put in a high, but it can also reset and continue for a second leg up. 3 levels of rise, a reset, and another 3 levels of rise. And that second level of 3 levels may be the last level where we get 25, 25, and 25 peak formation. They pull it back and reverse it into the night. So again, just to reinforce with the NASDAQ, once Asia and London are on board, I can define a high and low. Now, we had a 3-day setup heading into yesterday's U.S. session. And again, coming back to geometry and classical charting patterns, the Fed is a classic pump and dump. The high of the day was taken out right off the bat. We had a triple top. We talked about this, I believe, yesterday. The market continued to auction down lower, putting in a peak formation low into the end of the Asian window. Get rid of the screen line. And that also came up to our lower high in Asia. The market creates a box in that upper level. There's our level 1, the whole thing becomes a measured box, a measured geometry, a rectangle. I'll just zoom this in. Okay. So when I see something like this, the first thing I do is I want to draw the high and the low, and I'm looking for a range expansion. Now there was a couple trades. There was one in the first hour last night for low-hanging fruit. I talked about that. Okay, and sometimes with the NASDAQ, as we saw, you'll see a volatile first few 15 minutes. But if my thesis is that we're on day 3 and this is potentially going to be a large move down, I'm looking for the pin hammers in that first 15 minutes, stop hunting up inside of that original breakdown. So there's multiple ways to trade this. Traders might be on a 15-minute chart, 5-minute. It doesn't matter. Again, I'm looking at levels. So once this market goes vertical and hits stops, towards the end of the 15 minutes, I'm looking to get filled at the numbers. This is at 75. So if I'm trading this, I want to get filled at the numbers. So I talked about don't get fooled by the illusion. Don't chase the illusion. Focus on price. Remember, there is nothing hidden here. This is all price and time. That's nobody's concepts. Somebody didn't just figure that out. The time of day when this happens is already preset. It has been since the beginning of markets. And then you're dealing with price. What price? If it's going down, I want to sell at the highest possible price when the session starts. If it's going up, I want to buy it at the lowest price possible after the session maybe has locked in the low or is reversing, or I'm in an up move. If you're not sure what these patterns look like, go and look at them. Print them off. 3 push patterns. They're everywhere. If I see that the level is there and the pattern is there, I'm looking at numbers. It's price. If you're chasing candles, your fill price will always be worse than what the price is for where they're getting filled at. The volatility will fool you. It's 50. It's 50. It's 50. It's 50. If the buy is at 50, it's at 50. You can chase all the candles back and forth that you want. You can get in at 70, 72. No problem, but I'd rather get in at 50. If I get in at 56 and that's my best price that I can get filled at, okay, that's the best price. I put my stop down below 20 pips. It shouldn't come back down into this level. The point if they're going to reverse, they're going to go fast. Why? Because they've got people in profit, and they're going to go as fast as they can back through those people who are in profit if that market is indeed going to reverse. So again, just reinforcing, like I talked about gold, it was inside yesterday. I didn't like that. To me, that's a more difficult market to trade. And remember, I'm looking for simple stuff. I'm looking for simple patterns. 3 levels of rise, sell it. It could be 3 pushes in a 25 pip box that takes 30 minutes. If it gives me a sell pattern at the quarter level in a down market, I'm going to sell it on the 3rd level. If it's into a peak formation, whatever that may be. So Euro Friday, we saw a peak formation back and forth. When you see that, okay, what does that look like? That's a multi-session W. And this is also, if the market reverses, which we saw it come out on Monday, trap volume. All this volume's trapped. That whole thing. It can be a multi-day reversal. So when you see this and you think, oh, the market goes vertical on Tuesday, you think you've missed the trade. You come back later and you go, oh, how did I miss that? Maybe you didn't miss a thing. Maybe this is a running market, okay? But now what you want to be thinking of is day 1. That's level 2. When it goes vertical out of a consolidation, that's level 2. That's the straightaway trade. But when you see that, what should you be thinking? I might get a day 3 trade setup. Level 1, level 2, higher lows. Look at the consolidation. I can see clear as a bell just by squeezing the chart together. And when you see a consolidation like this, that's trap volume. Peak formation high. Market drops down and breaks down in the Europe session. Okay, so this is before you might not even come and look at this. This is not hindsight. This is what I am looking for. Understand that. When a market puts in a peak formation and breaks down after a runaway market, what should you be thinking? They're going to go vertical, straight down. U.S. Swiss, we had a first red day on Monday. Took out the high of the week, high of the month, I believe, as well. Broke down and got a day 2 trade right at the Europe window on Tuesday for a nice vertical move right into the end of the U.S. window. beginning of the U.S. window, where it went into consolidation and then pulled back and gave us an M, and then at the New York Open gave a brilliant 100 pip, 7,500 pip vertical move straight down back to where that whole pump and dump pattern began. So again, even over the weekly template, simple setups, looking for, again, these are opportunities that are going to show up all the time over and over again. Canadian dollar, I see nothing that was at all appealing to me in terms of an ideal opportunity. There was news last night, but I saw nothing whatsoever. That I saw a market that was completely consolidated, and there's zero there that interests me in terms of anything of an ideal setup. Gold Monday, Tuesday, Wednesday was inside. I had no interest in looking at that because this is what you'll typically get, is that inside back and forth chopping market. And I know that from experience in a choppy market, those are the types of markets that traders can tend to end up getting caught up in. Oil, consolidation, level 2, level 3 on Tuesday, breaks down, pulls back in 3 pushes for the vertical move right at the New York Open, straight down for a large move. They put in a peak formation low. Notice where all the back and forth two-sided trading is. They go straight up through that. That's order flow for a nice vertical move up through traders who are short on the lower level, the last level of that move down. And again, the NASDAQ, high and low, day 3, 3 pushes, peak formation, and a large rectangle pump and dump box for a measured move in a broken down market for a full range expansion, high to low. One full expansion high to low on day 4 now and down at the bottom of the week. Euro yen, same thing, peak formation low Thursday, Friday, consolidation, trap volume again on Monday. Peak. Notice the vertical move on Monday going down into the consolidation. That's a peak formation. Day 1 peak formation, day 2 vertical, day 3 3 pushes into the high, breaks down a running wedge for a vertical move. And this green box is the space from the swing low from the breakout. So that's a dead giveaway that if the market starts to break down, it will go vertical right through there. There's nothing to stop it. Pound yen, same sort of pattern. Again, the vertical move down, the dump, and then the pump. 3 levels of rise, 3 pushes, day 3. Broken down market into the U.S., right into the U.S. session, straight down back to where that move originated. So step back, identify the best setups. Don't worry, I do not have any interest in trading inside. I don't want to be trading inside. Count the days, count the levels. Let it go to the high or to the low. If you're not in at the high or the low, the market, has it already locked in a high or a low? Are you in the middle of a move? Or are you trading inside of a high and low from in a choppy range? Filter out the garbage. Stay out of consolidated markets. Index, NASDAQ, 25 to 50 pips above or below the range. Looking for that first 15 minutes to burst and hit stops on one side. Let them put in a peak formation. If it's a trending day, you will not get a pump and dump. You will get 3 levels of pullback inside of a trend. So that's distinctly different from a pump and dump. A pump and dump goes vertical. A pullback will work its way in 3 pushes, 25 to 50 pips inside of a trend that's already in place. Keep it simple, traders. Print off your charts. Look at what the best setups are. Do not get caught in choppy markets. Stay disciplined. There's plenty of great setups. Wait for the best ones. Look for 3 levels of rise or fall. Look at the timing window. Asymmetrical risk reward. Keep your stops tight, and may the markets go with you.